Well, hello friends. This lovely occasion, I will explain to you all about the money. This video is made for the midterm assignment from the subject Money, Banking, and Financial Markets. For coming to the explanation, allow me to introduce myself first. Well, my name is Dicky Rusmadi. You can call me Dicky. My IP number is 19105130014. I'm from International Economic class in Universitas Andalas. Well, let's go to the explanation. Well, what is money? Money is an asset that is generally accepted as a payment for goods and services or the payment of debt. Where the money come from? There are two kinds from where the money come from. The first is wealth. Wealth is the total collection of pieces of the property that serve to store value. The second is income. Income is a flow of earnings per unit of time. So, what is the money function? The first function of money is as a medium of exchange. Promotes economic efficiency by minimizing the time spent in exchanging goods and services as a way of avoiding the complexities and difficulties of barter. The second function of money is as a unit of account. Unit of account is a standard numerical unit of measurement of the market value of goods, services, and other transactions. As a measure of value, money makes transactions significantly simpler. The last function of money is a store of value. A form of store of value is a form of money or financial capital must be able to be reliably saved, stored, and retrieved and be predictably useful when it is so retrieved. Well, we come to the characteristic of money. The first characteristic of money is the money must be easily standardized. The second, the money must be widely accepted. The third, the money must be divisible. The fourth, the money must be easy to carry. And the last characteristic of money is the money must not deteriorate quickly. Well, here is the evolution of the payment system. The first is commodity money, and then fiat money. After that, checks, then electronic payment, and the last is e-money. Well, in this occasion, I will explain all of the kinds of evolution of the payment system. First one is commodity money. Commodity money is money whose values comes from the commodity of which is made. A commodity money consists of objects having value or use in themselves or intrinsic value as well as their value in buying goods. Second is fiat money. Fiat money is a government issued currency that is not backed by commodities such as gold. The third is checks. Checks is a document that is ordered in a bank to pay a specific amount of money from person's account to the person's whose name in the check has been issued. And then electronic payment. Electronic payment is a way of making transactions, of paying for goods and services through an electronic medium or without use of checks or cash. The last is e-money. E-money is electronic money that is used in electronic transaction on the internet. Typically, these transactions involve the use of a computer network. Well, after this, I will explain about other forms of payment. There are so many forms of payment. Here is credit cards, debit cards, electronic funds transfer, and stored value cards. Well, a credit card is a payment card issued to users to enable the cardholder to pay a merchant for goods and services based on the cardholder promise to the card issuer to pay them for the amount plus the other aggregate charge. And then debt cards. Debt cards is a payment card that deducts money directly from a consumer checking account to pay for a purchase. Debt card eliminate the need to carry cash or physical checks to make purchases directly from your saving. And then electronic funds transfer. Electronic funds transfer is the electronic transfer of money from one bank account to another, either within a single financial institution or across multiple institutions via computer-based system or without the direct intervention of bank staff. Then stored value cards. Stored value card or gift card is a type of electronic bank debit card. Stored value card have a specific dollars value preloaded them. Credit card networks, bank card issuer, and retail merchants provide this card as a way to provide non-cash payment cards to the public for a variety of purposes. Well, after this, I will explain about money and inflation. Increasing the money supply faster than the growth in real output will cause inflation. The reason is that there is more money chasing the same number of goods. Therefore, the increase in monetary demand causes firms to put up prices. Well, I will show you an example inflation in Indonesia. There are three periods of inflation in Indonesia. The first one is pre-crisis period, then crisis period, and the last is past crisis period. Indonesians have a crisis period in 1998 and 1999. So that I will explain about the monetary aggregates. A monetary aggregate is a formal way of accounting for money, such as cash or money market funds. Monetary aggregates are used to measure the money supply in a national economy. The function of a monetary aggregate is to avoid sustained episode of high inflation. A central bank must be concerned with the money growth. Uh, Kinds of monetary aggregate is M0, it is base money, M1, narrow money. The formula of M1 is M0 plus demand deposit or base money plus demand deposit. And then M2 or broad money is the formula is M1 plus time deposit or narrow money plus time deposit. I will explain about the monetary base or M0. The monetary base or M0 is a monetary aggregate that is not widely observed and differs from the money supply, but it is not less very important. It includes the total supply of currency in circulation in addition to the stored portion of commercial bank reserved within the central bank. This is sometimes known as high-powered money or HPM, since it can be multiplied through the process of fractional reserve banking. And then about narrow money or M1. M1 is a narrow measure of the money supply that is includes physical currency, demand deposit, traveler checks, and other checkable deposit. And then is M2 or broad money. M2 is a calculation of the money supply that is includes all elements of M1 as well as near money, which refers to saving deposit, money market securities, mutual funds, and other time deposit. These assets are less liquid than M1 or narrow money, uh, and not as suitable as exchange medium, but they can be quickly converted into cash or checking deposit. Well, I will explain less about velocity of money. Velocity of money is a measurement of the rate at which money exchange in an economy. Here is the example of velocity of money. From the graph, we know that the velocity is stable. The historical data confirm then the Fisher's conclusion that in the long run, the velocity of money is stable. The controlling inflation means the controlling the growth of monetary aggregates. Well, that's all my explanation about the money. I'm sorry for making a mistake. Thank you for watching this video. Goodbye and good luck.